Well, so what will a rate cut mean for the markets? Will it be a buy the rumor, sell the news event? Joining me now is Schwab Asset Manager CEO Omar Aguilar and Carson Group Chief Market Strategist Ryan Dietrich. Guys, welcome. Happy Tuesday. Omar, we are expecting a quarter point cut, but underneath that, what are we going to learn tomorrow that's going to move the market either way?
Well, 25 basis points is almost a given. Any other decision will probably end up bringing a lot of volatility to the markets. I think the key messages that the Fed may do afterwards will have to do with what is their measure of inflation. I think the unemployment and the labor market is the one that actually has given us a 25 basis points cut for tomorrow. I think the inflation numbers and their review on how they evaluate the effect on inflation going forward is what is going to determine the pace of how many cuts they do from here on. And I think the market will be very focused on precisely how they change their dot plots and how they change of that trajectory so that they can understand that trade-off between what they see in the economy that seems to be very resilient, but at the same time, their inflation is above their targets.
Okay, so Ryan, so historically, after cuts at all-time highs, stocks move higher. Do you expect that this time?
Yeah, John, thanks for having me back. We do. I mean, I know you've talked about it all day, and I've shared this too. 20 out of 20 times the stock market's higher a year after a cut within 2% of all-time high. That's where we are. But I'm a big message of the markets person. Like, what's the market saying? I mean, a year ago right now, the Fed cut 50 basis points. I think we forget that. Everybody told us, oh, my goodness, every time they cut 50, it's a recession. We push back against that in a big way, and as Mike just talked about, now we're up a lot. But what's leading this market, right? You've got consumer discretionary relative to staples hitting new highs. You've got staples relative to the S&P 500 hitting new lows, high beta relative to low beta hitting new highs. Long story short, the market is telling us this is still a bull market. It is the second half of September. Everybody's pretty excited about this rate cut. Options markets are pretty, kind of optimistic. Maybe you can get a little bit of a banana peel sell off on sell the news, but bigger picture, this is still a bull market. We like the fourth quarter rally here.
Okay, so Omar, you mentioned the labor market. Are tariff concerns taking a backseat now for the rest of the year? Labor market fears riding up front?
Yeah, I think the uncertainty around tariffs has clearly gone sideways. I think there's still, potential that will actually come back later in the fund because it takes around 18 months for tariffs to actually take into effect. And if you remember, a lot of the tariff cost was actually done early in the year. A lot of the consumption that we ended up having across consumers and companies for trying to prepare for the potential increase in cost, happened early in the year. I think what we did observe, which was kind of interesting in this bull market, is that the level of concentration has actually benefit for those companies that have the most ability, higher margins to potentially absorb the potential tariffs, impact later on.
Okay, Ryan. So given you're bullish overall, how should investors treat international stocks and small caps?
Yeah, we still like international. We've liked it for a while. We actually added a little bit more international back in March, and we thought maybe the dollar goes lower. But this stage of the economic cycle and with the bull market, we think that baton's being passed around. We think, again, there's some cheap valuations, some good earnings growth, developed international, specifically Europe. We like that. Now, small caps, we're still a little bit underweight small caps. Again, big picture, we think large caps still going to do better. One quick thing on this. The market is looking for 6 cuts over the next 15 months. We think the economy is going to be a little bit better. Maybe you don't get quite that many cuts. Nothing wrong with small caps here, but we still think we're sticking with who brought us to the dance, John, and that's large caps, industrials, financials. We like those areas. We still think they're going to do better than small caps, let's say, over the next 6 months or so.
Omar, you find these retail numbers, these consumer numbers encouraging?
No, we do. You have to, right? I mean, everybody keeps telling us how bad everything is. Yeah, the data keeps coming in pretty solid, so we're encouraged.
And Omar, how about you?
Yeah, no, we clearly think that retail provides this concept that the economy is fairly resilient. GDP continues to potentially go on and accelerate because a lot of the capital expenditures, even though we've seen already some of it, I think the rest of the year we're going to see that acceleration of capex because a lot of companies have delayed that capital expenditure deployment because of tariffs. So we may see an increase on capital expenditure that may get the economy going again. And again, that's where the Fed needs to decide whether or not that potential boost on capex, together with increase in productivity and the consumer, continue its path, it may actually reignite inflation. I think that's probably what is going to end up happening. We encourage our clients to continue to diversify and then prepare for what comes ahead.